Hello everyone and welcome to our webinar today. We're going to be jumping into decoding cash flow financing, how to really get financing even if you have challenged personal credit. What we're going to talk about today with cash flow financing literally is the fastest, easiest way to get business financing right now. And the reason I'm choosing to do this webinar is because these are everywhere. You constantly see these advertisements on Facebook, on Google, everywhere you look. And a lot of people as a result come and have questions about, is this legitimate? What's this all about? So we're going to dive in and dissect what is called cash flow finance. It actually has a lot of other names that we're going to be diving into. So before we get too far in, let me introduce myself. My name is Ty Crandall. I'm actually the Director of Business Services here at Credit Suite. What we do is help companies get business credit and financing and also give them the ability to offer business credit and financing as a service to their customers. So if you're at all interested in that, feel free to check us out. Our website is creditsuite.com, and I have a special page you can check out with all the details that is /business credit. So it's creditsuite.com/business credit. You'll see that on my very last slide today. I'm not pitching anything today. There's not going to be any kind of sale taking place. This is just going to be an hour's worth of straight information. My goals for these webinars are always that you could leave with a lot more details and knowledge than you came in with. So a little bit about me is I've got about 16 years of financial experience, and I actually right now oversee the largest business credit operation in the country. We have about 600 partners out there selling business credit and do millions of dollars of business each month amongst our partners. So I'm very versed in the business credit and financing space, but we also offer every legitimate type of financing that's out there. So we literally fund millions and millions of dollars of these type of deals, and that's why I wanted to do this today with my knowledge and share this with you so you know what's what, you know what's legitimate, and you know exactly what there is you should be looking for. So revenue-based financing. Well, from Wikipedia, which is a phenomenal source, revenue-based financing or royalty-based financing is a type of financial capital provided to smaller growing businesses in which investors inject capital into a business in return for a percentage of ongoing gross revenues. Now, this has always been the standard definition, although it's changed a lot as you're about to see. This used to be for larger companies. Now it works for more small business, and now even as in lieu of investors, you're finding more and more banks, more and more lending institutions actually getting into revenue-based financing. So usually the returns to the investor continue until the initial capital amount plus a multiple, which is also known as a cap or a discount, which we're going to talk about later, is repaid. So that is the definition of revenue-based financing. Now that probably doesn't provide you a tremendous amount of insight, but the details we're about to jump into definitely will. So revenue-based financing is often described as sitting between a bank loan, which typically requires collateral. In almost all cases, bank loans require collateral because in the business space, the most common bank loan is an SBA 7A loan, and those loans require, per SBA, that everything that can be used as collateral be used. So almost all business conventional bank loans do require collateral or significant assets, and angel investment or venture capital, which usually involves selling an equity or portion of the business in exchange for the investment. These have always been two of the most common paths people choose. They look for a private investor who takes a percentage of equity of the company in repayment for the amount they're giving you, or you go to a bank, which requires you have a ton of collateral and assets and good credit and all these type of things. Well, revenue-based financing kind of slips in between because you don't really need either. You don't need to give up equity in your company, and you definitely don't need good credit, nor do you need any kind of collateral or significant assets to qualify. So with this, investors do not take any upfront ownership or stake in the business at all, and this type of financing, you're basically selling your future revenue for a fee, or what's commonly known as a discount. So that's really how this works, is what happens is they look and they see that you have consistent current income or revenue, and they say, okay, we're hedging our bets that this revenue is going to continue to come in, and we're going to buy your future receivable revenue for this discount or this price. That's how it works. So ultimately, your future, the potential of having future revenue is the collateral. This is why you don't need to supply any other kind of collateral to qualify for this type of financing. So there's a lot of different names that this goes by. RBF, or revenue-based financing, revenue-based funding, revenue-based loans, revenue financing. cash flow financing, cash flow based financing, cash flow loans, bank statement loans, ACH financing, even royalties based financing. So I mention these because if you look at ads online, you'll commonly hear these referred in a lot of different ways under some of these names. So if you hear anything related to cash flow or bank statement financing or revenue based type financing, all of those names are the exact same product that you're about to learn about today. So cash flow financing, do you have 10,000 a month gross? These are actual ads from Google. So if you look online, or Facebook has it's not as short, like they shorten things like per month here because they're allowed only a certain amount of characters if you're advertising on Google. So Facebook it's spelled out a little bit more, but these are actual ads from Google. So you can see what we're talking about here, because again, you're going to commonly see these ads, and I want you to link what's being advertised to what the real deal is. So we're going to dive into the real deal today, and what you're seeing here on this slide is the actual ads or reflections of the ads you're actually going to see on Google. So cash flow based financing, do you have 10,000 per month gross sales? Quick and easy. Cash flow finance, fast and simple online app, need 150K in sales, profitable. Now this is common. What you'll commonly see with these kind of advertisings, and how you can easily know exactly what you're looking at, is they'll usually have an amount like 10,000 a month or 150,000 a year. So if they're saying you've got to be in business 6 months, you've got to be in business a year, or you have to have 10,000 a month in sales or more, that's usually what they're referencing is revenue-based type financing. How to get business financing when banks turn you down? Well, this is an easy reflection of, hey, how do you get money when you have bad credit? And this is typically an advertisement you'd see for this kind of financing. Bad credit business loans, 24-hour approval, no startups. You'll commonly see this in these advertisements. So if you're dealing with a revenue financing kind of ad, they usually will reference 10,000 a month or more needed in sales, no startups. And if you see this kind of language, it's indicative that you're probably dealing with a cash flow based financing kind of product. Fast small business loans, 24-hour approvals. Another one. You see how you're seeing this trend of 24-hour approvals. These are very fast, easy types of financing. So again, if you're seeing things reference 10,000 a month or no startups or fast approvals, then they're usually referring to cash flow based financing. Small business loans, 24-hour approvals, online app, minimum 10,000 monthly in sales to qualify. So this is a cash flow financing advertisement all day long. And if you type in bad credit financing into Google, you'll pull up a ton of these kind of similar ads. So although for many small businesses this is like a new concept, it's actually been around for a long time. And it's usually in the past been used in industries that are like higher dollar industries that have high upfront costs required in their industry. So for example, filmmakers, oil drilling outfits, pharmaceutical companies. These are all examples of companies that used this kind of financing since its inception. It was actually kind of created to cater to these kind of industries that had very high upfront costs that they needed to get money for. Revenue-based financing has always been popular for big industries with loads of revenue coming in. With these types of transactions, it's not uncommon to see 3 to 5 year terms. So with these bigger companies that get really large amounts of receivable or cash flow based financing, 3 to 5 years has always been the term. But recently you're starting to see this apply to a lot of small businesses, and this is why all these ads have started to pop up and all these new companies are out that offer this kind of financing, because there's more and more lenders now saying, hey, this product has been successful. These people can't get done at banks. We're getting them done, and statistically looking at their success rate, a lot of them are successful. This is a profitable avenue, so let's get out of the big business space and start spreading this into the small business space, and this is what's been happening recently. So nowadays, the terms on these are commonly 6 to 18 months. That's pretty common. So if you're a small business looking to get, or a large business, but you're looking to get $500,000 or less, it's very common that you're going to be given 6 to 18 month term. Until you're into the millions of dollars, you're not going to typically see these longer terms that's still reserved for these bigger, really high dollar companies. But the average business owner that we deal with, somebody that's generating, let's say, $5 million in revenue or less, you're typically going to be looking at a shorter term financing of about 6 to 18 months. So revenue-based financing is not a loan, and it's advance of your revenue. Now, this is funny because if you look at a lot of the lenders that actually lend this kind of money, they will call it a loan, even though it's not a loan at all. They call it a loan, I think, for simplicity reasons, just so people that are looking for certain kind of financing or searching certain keywords will get to them. But in reality, it's not a loan at all, and it's an advance of your existing revenue. So it's very similar to a cash advance in the consumer world. This is what this is. Revenue financing is a cash advance for business. That's what it is. It's an actual cash advance. So if you think about a consumer cash advance, your current pay is analyzed. You then are lent money based on the stability and amount of your pay, and then you have a short term to pay back what's been borrowed. So AmScott is a perfect example. This is AmScott's niche. This is what they do, is they'll give you free money orders, of course, to get you in the door, but their real goal is that you come to them when you need money. And then all you need is your driver's license and a paycheck. So you give them your paycheck stub. They look at your paycheck stub. They see that you have consistent income. They see what your income is, and they lend you money based on the amount of income that you have, and that money has to be paid back quickly. I'm not sure of the term on those, but I'm pretty sure it's 90 days or less. I think in a lot of cases like AmScott, you have 30 days or less, maybe as much as 45 days to pay it back. So it's short-term money only looking at your pay. Same thing in the business world. It's short-term money only based on a quick look of your actual revenues. So speaking of a quick look, let's talk about document requirements. So with revenue financing, the lender's going to typically look at two main forms of documentation. Your bank statements. They're commonly going to want 4 to 6 months of your business bank statements. Somebody's asked me before, well, can I use my personal bank statements? No, you cannot. If you are using your personal bank account for business purposes, that is a huge no-no. Nobody will touch you with a 10-foot pole when it comes to lending. You've got to use business bank accounts if you're actually depositing and withdrawing business transactions from them. So you've got to have business bank statements, typically 4 to 6 months. Merchant statements. So if you have a merchant account, now, you might not know what a merchant account is, so I will explain that. A merchant account is a company that you process credit cards with. So if you accept credit cards, then you usually have a merchant account, whether it be through PayPal or another source. If you do process credit cards, they're going to want to see 4 to 6 months of your merchant statements as well as your actual bank statements. And they're usually going to want a driver's license and any kind of rent, lease, ownership information about the property. They just want to make sure you're going to be able to be around a while from now. And we actually had one of these that was a problem where the client wanted to get revenue financing. They asked for his lease. He couldn't provide a current lease because he was wanting to get the money to pay the outstanding rent that was due. That's exactly what lenders are looking for. You know, if you have a retail store and you're not paying on your lease as agreed, well, then you could lose your business overnight and they could be stuck with the money. So they always want to verify that if you have a rent, or you do rent, if you do lease, if you do own the property, that mortgage or that rent is in good standing. So they will verify that your rent or whatever it is you're paying is in good standing, your driver's license, and they're going to simply want 4 to 6 months of your bank statements or merchant statements. That's it. That's all they're going to actually want. You can qualify even if you have a home-based business. So don't think just because I'm mentioning rent, lease, or ownership information that you have to do that. If you're running a home-based business, that's fine. They might ask you to verify that you're up to date on your home payments. But we see revenue-based lending for home-based businesses all the time. Okay, I never secured the actual financing, but I was approved way back when, many years ago, when I was actually had a credit repair business, and before I sold that business, I went through, tested this, and I was approved at 3 different lenders because we had a lot of money come through our bank statements and we didn't really have many chargebacks. So we were perfect even though that business was a home-based business. So yes, you could definitely get approved if you're a home-based business. We see businesses all the time get approved as a home-based business. So lenders are looking for very specific requirements when qualifying you. The bank statements are analyzed for consistent deposits. So this is one of the main things they're looking for is, do you have consistent deposits? Like, they don't want to see that in September you had 2 deposits, and then in like August you had 1, and then in October you have 9. What they're looking for is consistency. They want to see that preferably you have a lot of deposits taking place in any given month. Okay, so for example, a perfect example of this is they don't want to see like a few big deposits. They want to see a few. So for example, a retail store. So if you're a retail store, like somebody that sells surfboards or somebody that sells widgets or a boutique, we'll use a boutique as an example. So a boutique is a perfect company that would qualify for revenue financing because like a lot of people walk in their door and they buy clothes and they do a lot of transactions in a day. Like it's very common for a boutique to maybe do 5 or 30 different transactions a day. So there's constant deposits. Like almost every single day in a month there are deposits, about 30 or more deposits in a given month. Okay, versus a real estate agent, which is a bad example. They're not going to qualify for revenue financing because a real estate agent might only have 2 or 3 deposits a month. They're really big. So like a real estate agent might say, well, hey, I've got, $15,000 a month coming into my bank statements. Well, that's great. Well, how many transactions is that? Well, it's 3. Well, they don't want to lend on that because here's the question. If you lose one of those deposits, you just lost like 33% of your total deposits for a month. So it's very versatile when you only have a few deposits. So they're definitely looking for as many deposits as they can get, consistent deposits, a lot of deposits, anywhere from about 8 to 30 is the preferred number that lenders are actually looking for. Just so you know, there are lenders that won't even look at this unless you have 15, 20, or 30, and then there are lenders by exception that will go as low as 8 or 10, but 8 or 10 is an exception with this kind of financing. They really want to see a lot of smaller, consistent deposits versus a few big ones. They're looking for a positive ending bank balance. Okay, so what's happening is they're going to take money back from you daily. So they want to make sure that like money's there to take, and one of the best reflections of is there going to be money there to take is do you have positive bank balances at the end of each month? Like if at the end of each month you're negative, well then they're not going to want to lend you money because you don't even have enough money to pay your current arrangements, let alone pay them back. So they definitely want to see that you have positive ending bank balances. Because again, if you don't have money left over each month, then it's going to be tough for them to get paid back. So they're looking for positive cash flow each month. Okay, you could have a lot of expenses. They don't care. All they care about is that you have more money coming in than you have going out. That's positive cash flow. Your cash flow is positive, which means that you have more money coming in than you have going out. And that's one of the biggest concerns that they're looking for in this kind of financing. They want to see that the bank account is managed responsibly with little to no NSF charges. So they don't want to see that you have a bunch of non-sufficient fund charges, which means you overdrew the account. Like you had, $100 in your account and then today you had $200 of expenses go out. Well, they don't want to see that. They don't want to see you overdrafting the account because again, it's reflection that you're having a problem managing cash flow, that you don't have enough positive cash flow to pay them back. So preferably they need to see less than 5 NSF charges a month on your bank account. If you do have more than 5, then you need to now start managing that cash flow better so you have less NSF charges because it's one of the primary factors that they will, not primary, it's one of the secondary factors that they'll look at is these NSF charges. They also don't want to see a lot of chargebacks, which could reflect unexpected future expenses. So on your merchant statements, one of the reasons they're getting your merchant statements is to see how many chargebacks you have. This is how many people that you charge money to that then called their credit card company and said, I don't know who these people are. This is fraud. I never charged that money. And then all of a sudden the credit card company charges you back. They take the money back from you and they make you prove your case that this was a legitimate transaction. Now, anybody accepting credit cards knows about this. Even in my business where it was very few, we would do maybe one chargeback per every 3,000 or 5,000 transactions. It was so minimal. I still am familiar with what chargebacks are. Almost anybody dealing with credit cards is. So they don't want to see a lot of chargebacks because that could be, they don't know what's happening. If you got 20 chargebacks this month, well then they don't know what's going to happen next month. Even though your cash flow looks good, what if you get 40 chargebacks next month? And plus, that's not reflective of somebody that usually has a really solid, honorable business, because if you do, your customers are going to call you and go, I have a problem with your product or service, please refund me. If they feel compelled to call the credit card companies and claim it's fraud, then there's a whole other problem. So if you have an abundance of chargebacks that is not preferred, it's going to be tough to get this kind of financing. So lenders may have many restricted industries or high-risk industries. And the finance industry as a whole is one of these restricted industries. Now, what you're seeing here is not reflective of everybody's high risk industry. Like everybody has different industries they claim to be high risk. But what you're seeing here is very reflective of the general norm of what is considered quote unquote high risk in the business revenue lending space. So financial services and investments, we work with a lot of credit repair companies because a good solid credit repair company also offers business credit. It's hand in glove. Like a credit repair company that doesn't offer business credit doesn't make as much sense, because if you're dealing in the credit world, you might as well deal with consumer and business credit, right? So we deal with a lot of credit repair companies. It's like a lot of our client base. And a lot of them get frustrated because credit repair is on the restricted list. But it's not credit repair that they care about. It's the financial services industry as a whole. It doesn't matter if you're a real estate agent, an insurance agent, a property manager, a tax preparation company, or an accountant. Okay, we've seen very good accounting practices get denied for revenue financing. So financial services as a whole, they don't like for this product. Sellers, mobile phone dealers, pawnbrokers, flea markets, mail order type companies, they call vices, adult entertainment, lotteries, drug paraphernalia, horoscopes, okay, vehicle and power equipment sales, service administration companies, title companies, mailing and fulfillment companies, call centers, payroll companies, okay, travel and transportation, miscellaneous such as mining, video rentals, vehicle manufacturing. All of these are on the restricted industry list. Now, let me throw up a huge, massive disclaimer. This does not mean that you cannot get financing because you're in this industry. As a matter of fact, we do a lot of financing for people in the restricted list. Off the top of my head, I can tell you we do credit repair companies, have done many. We've done accountants. We've done drug paraphernalia and dispensaries. We have actual lenders that are looking for anybody in the marijuana industry right now. So we've done these kind of deals. So we've done a lot of these. There is something we're going to talk about later called compensating factors that would allow you to still get done if you're in a restricted industry. Now, that doesn't mean you could probably go to the lender right away and get approved. We get a lot of these approved because we just do so much volume. Like we do so much volume with our lenders that if we throw one in that might be a restricted industry but has compensating factors, our success rate with this financing is so much that they'll approve them. So I'm not saying you could just go if you're on this list and have compensating factors and get approved, but I'm also telling you that that doesn't mean that you're completely prohibited. This is a restricted, not a prohibited list. So this means there are restrictions of what they will do. You have tighter standards you must adhere to get approved if you're in one of these quote-unquote higher risk industries. So the longer time you've been in business, the better your chances of actually getting approved. Bottom line. So there's a lot of requirements when it comes to revenue financing, and this is one of the things they look at is how long have you been in business. So most lenders require that you've been in business for 12 months or more. There are some lenders who will lend you money if you've been in business for 6 months or more. You'll see this with these advertisements. Like when you look at these advertisements that are out there, you will see that some of them say you got to be in business 12 months, some of them say you have to be in 6. Well, 12 months is the norm in the industry, but some lenders will go as low as 6 months. But in those cases, I usually want to see these compensating factors that we're talking about. I'm not sure if I'm going to list compensating factors here or not, but there's a lot of things that can be compensating factors. You've got good time in business. Well, basically, everything I just showed you so far could be a compensating factor if you're solid there. You have really good credit. You've been in business a long time. You really manage your cash flow responsibly and have positive ending bank balances. Any of those type of things could be compensating factors whether you're in a high-risk industry or whether you've only been in business 6 months to still be able to get approved. So personal credit's not a big factor for approval with this, but they will tie into the terms you pay. So it breeds skepticism. If I just tell you that somebody can get money with bad credit, immediately like alarm bells start going off in your head, red flags, scam alert, but it's really not. And if you think about it logically, it makes perfect sense. They don't really care about your personal credit because your personal credit and how you pay the bill has nothing to do with this. They're going to deduct the money from your account daily. So the money's going to be taken if the money is there. So all they really care about is the money there? If they look at 4 to 6 months of your bank statement, see that you manage your cash flow responsibly, see that you have positive ending bank balances, that is their priority. That's their driving factor. Is the money going to be there to take when we go to get it? Yes, month after month after month after month, It looks like there would be money here, there would be money here. This is a good deal. So they don't really care as much about personal credit because that reflects how you pay your personal bills. You're not even going to pay a bill here. They're going to auto deduct the money. So all they care about is the money going to be there, which is why their primary concern is management of bank account, nothing to do with personal credit. But lenders often approve business owners with scores as low as 500 with this. Now, lower than 500, you start to get into a sticky space. Again, if you have compensating factors, that might be possible. But we often and commonly see customers with 500, 512, 520, 530 type of credit scores actually get approved. So you do not need good credit. You don't even need average credit. I mean, let's be honest. Average credit per FICO is about 650 score. You can get done with 500 here. This is the low end of bad credit, and you can still get approved. I'm not trying to put you down if you have lower scores. Things happen in life. I'm just telling you that no matter how bad and out you are on your credit, you could still be a candidate here if you have the actual other qualifications met. So lenders are more concerned about you not being in trouble, such as an imminent bankruptcy or very recent liens and judgments. So that's all they're really concerned with. They don't really care about other derogatory credit. They just want to make sure that like it doesn't look like you're like going on an impending bankruptcy, like it's imminent, or that you have very recent judgments and liens, because they're concerned there that those people are going to garnish wages and do other things. They're going to create a financial hardship. Okay, but if you don't have these type of issues, you can get approved even with recent collections and late payments. So it doesn't matter if you have recent collections, recent late payments, even on major accounts, you could still be approved. They're just concerned that like you're imminently in trouble where people are going to start garnishing wages, garnishing assets, because that would obviously create a financial hardship which would impact your business. So this is one of the best types of financing to secure with credit issues. It really is. If you don't have collateral, it is the best kind of financing with credit issues, period. If you do have collateral, there's other financing out there you can get much better terms on that you'd want to go with that doesn't really look at credit either. So the question is, do you have collateral or do you not? If you do have collateral, well, there's all kinds of collateral-based financing that you can get at low rates. If you go to my YouTube channel and just search my name on YouTube or search business credit, I'm one of the first handful that pop up, then you'll find I've got other webinars that will reference how to get money based on collateral. But if you have no collateral, as a lot of business owners we experience don't, then this is the best kind of financing you're going to find out there with credit issues, especially severe credit issues. So this is not a loan. Again, as we talked about, there's no standard interest rate that you're going to pay. Everybody asks that. What's the interest rate? Zero. There is no interest rate because this isn't a loan. An interest rate is kind of reflective of what you get with a loan. But remember, this is a cash advance. So you're not getting any kind of interest rate. Instead, you're selling your future revenue for a discount fee. So for example, you might get a loan, and this is something you want to pay attention to because I'm about to show you how revenue financing really truly works. You're going to actually see firsthand how this really flows, how this really breaks down. So let's say you get a $100,000 loan. Let's say that the lender charges you a discount, which is the fee, of 20%. So your total payback is $120,000. Makes sense, right? You got 100 borrowed. They charge you 20%. 20% of 100 is 120. Okay, so now you're paying back 120. You're paying 100 back for what you borrowed. You're paying 20 back to the lender. Your total payback is $120,000. So if the lender were to finance the $120,000 over 12 months, it just keeps it really simple and easy, your payback would be $10,000 a month. That's exactly how it would work out, right? Just simple math. $120,000, 12 months, that's $10,000 a month is how much you'd have to pay back. So payments are withdrawn from your bank account daily. I've mentioned this a couple times, usually Monday through Friday. So it's usually about 20 to 22 days a month you're actually having a payment deducted from your bank account. So in this example, you would pay back $500 per day, just assuming there's 20 days. You'd pay back $500 per day, Monday through Friday, until the total amount is paid back 12 months later. That is revenue financing. You just saw it firsthand. You borrow 100, they charge you 20. Your total payback's 120. If you were to finance it over 12 months, it's 10 grand a month. 10 grand a month divided by 20 because there's 20 days. would come down to $500, and that's how much you're paying, is they deduct $500 per day, Monday through Friday, until the amount is paid back 12 months later. So the $500 is automatically deducted each day, so in many cases you won't notice it gone. Of course, in the beginning you will, right? You're like, $500 is gone from my bank account today. But eventually what happens is people get used to this. They get used to their cash flow being 8 to 12% lower than it was. They make adjustments, and they very quickly adapt and get used to this money just being taken out of the bank account where they don't even notice it gone. As a matter of fact, if you're a bad saver, I recommend you do the same thing. Okay, there's companies like Vanguard that will auto deduct money from your bank account when you tell them to, so you don't even notice it gone. It's one of the best ways I've ever seen to save for people that are not good savers. So they do it with this kind of financing. They just deduct the money every day, and how much money they deduct, of course, depends on the total payback amount and the total payback term, how many months you're actually paying them back over. So you usually be given choices when you could pay more or of a discount and get a longer term. So I'm going to show you here real bank underwriting materials they use to underwrite these, and you'll see that you get a choice. You could pay them a larger fee and get a longer term. They'll give you several choices to choose from. Or you could pay less fee and get, or actually this should be a shorter term, not longer term. So you can pay them more and they'll give you a longer term, or you can pay them less of a fee and get a shorter term is what happens. So the bottom line is what matters with these deals is term. A lot of people get caught up in the amount of the fee, but the fee doesn't matter as much as the term. You want the longest term possible. That's what keeps your payments low. So they'll let you choose. You pay us more money, we give you longer term. You pay us less money, we'll give you a shorter payback term. So each option has a different daily payback amount, and usually the payback amount is 8 to 12% of the actual revenue. That's what they do. So they look at your revenue, and they usually are taking about 8 to 12% of whatever your actual revenue is back as their actual payment. Now, most lenders will charge more money and give you a shorter term in the beginning until you prove yourself. That's just kind of how these deals work. Okay, you have to prove yourself. So when you first come in, they'll whack you over the head. I mean, they'll whack you over the head. They're going to give you a shorter term and a bigger fee just to almost scare you off. They want to make sure you're a good fit for this. And if you're managing your cash flow responsibly, then it'll work for you. And if you're not, you're going to know it's not going to work, and it's going to be a deterrent. That's almost why they do it. So when you get 50% of this paid down, though, they commonly will renew the advance, giving you an even longer term and lower payback. So I'm going to give you an example here because this is very important. This is something you need to clearly understand if you're even considering this kind of financing. They're going to freak you out when you first see the terms on this financing. They might charge you 20, 30, 40% as a fee and give you a 6 to 12 month payback. It'll freak you out. But again, what they're doing is they want to put you in there to make sure you can manage on those kind of terms. Then when you've paid half of that amount of money back, they'll take the original amount, redo it, and give you significantly better terms. And I'm about to show you a real example. So if we're in a real example here, you paid back, and we're reverting back to the other example we just had, right? So you borrowed $120,000 over 12 months. That was the example we just used. Now here you are, 6 months later, you paid back $60,000. So 6 months has passed, half of your term has passed, you paid back half of the loan amount. So now you have $60,000 that you still owe them. The lender looks and says, they call you up and say, listen, do you want to renew? And this really happens. They will contact you and want to renew. And just so you know how often this is, our clients statistically over 70% renew their loans. Okay, so these are very popular, very successful kinds of financing. So they'll look at 2 months bank statements. They call you and go, hey, you want to renew? Do you want more money? And you say, well, yeah, of course I want more money. And they'll say, send us your 2 most recent bank statements. And they're looking to make sure that your company is still growing. Because the purpose of revenue lending isn't for you to get money and have it sitting around. They want to know you invested the money back into your business and your business has grown as a result. That's what they're looking for. So they get your bank statements and they see that's exactly what happened. They now lend you another 40. So they go, hey man, Ty, you did a really good job. You took the 120 we gave you. You obviously invested it in your company. Your growth is now up 20%. So we've seen that you can manage the money responsibly. We've gotten paid back as agreed for the last 6 months. So here you go. Here's 40 grand. Think about what's happening here. You just sent them 2 months bank statements. And in a lot of cases, this happens in 48 hours. We had a client that couldn't pay their payroll. And so we got them money in 48 hours so they could pay their payroll. So these renewals are very fast. 2 months bank statements, wham, bam, you're done. Two days later, 40 grand sitting in your bank account. It's cool. It's so easy to get money to renew once you've proven yourself. So your term is lengthened from 12 to 18 months. So remember where we are now. You paid back 60, you owed 60. You got another 40, now you owe 100. And they gave you an 18-month term, and they said, hey, we're going to lower your payback from 20% to now only 12%. So now you don't have to pay us 20% on the money anymore, only 12. Keep in mind what's happening here. Your original 60 is included in this. So now the whole 60 plus the new 40 you got, the whole 100, gets stretched to 18 months. So this 12-month original term you had goes bye-bye. It's gone, done. You've now renewed this loan on an 18-month term instead of the original 6 months that you had remaining. Then they've taken you from 20% to 12% payback. So now what happens is you already used 60 of what you borrowed. You still have access to the 60 and the 40 you just borrowed. So now you have 100,000 you're borrowing at 12%, making your total payback 112, right? 100,000 you borrowed. They charge you 12%. That's 112,000 total what's owed. Now, please note, this would mean you truly never did have to pay the full 20%, remember? So what I'm saying is that you paid back half of that amount of money. And they said, okay, forget it. We trust you now. We're going to give you a longer term. We're going to 86 to 20 and put you on 12. So even though you're charged outrageous terms in the beginning, as long as you've proven yourself here, you never end up paying these terms because they renew you half the way through. And then as a result, your terms get significantly better and you never even have to pay half of that amount of money that you borrowed on those original terms because they redo the deal. So here's the math on that. 112,000 at 12% for 18 months. Okay, that's $6,222 monthly or $311 per day. That's crazy if you think about it. Remember what I told you before. You borrowed 120. You were paying $500 a day back. You paid $600 or 60,000 of it back, half of it back. You renew. You got another 40 G's, and now your payment's only $311 a month. Would you be happy? You'd be freaking out, right? So this is what happens with these deals. Once you prove yourself, then when you renew, they give you more money, lengthen your term, lower your payback. So in a lot of cases, your payment is the same or less as what you originally paid to get even more money. And all you had to do was make a call, or they called you, send 2 bank statements, 2 days later, bop, bop, done. Money's in the bank account. It's the fastest, easiest way you're going to find to get money, not only on the initial advance, but on these renewing advances, because once you've proven yourself, they lengthen the term, they lower the payback rate significantly, and then you're just paying back the same or lower amount per day with an extra 40. So think about this. You were used to paying back $500. They just gave you $40,000 extra, and your payments went down. Pretty cool. That is revenue financing. Now, it might not always be this way. They might not take you from 20% to 12. They might take you from 20 to 16 or whatever. But this is a good example of how revenue financing works. You often will be able to borrow more money on the second advance and at least keep your payment the same. Your payments will not usually go up very much if they renew this, if at all, and mostly will stay the same or go down because they're lengthening your term and they're lowering the actual payback amount that you owe them. So this is basically a very risky cash advance. You have to understand that from the lender's perspective. The terms aren't going to be great or anywhere close to a bank loan, but you can easily get approved for revenue financing even when there's no way you can qualify with the bank. Now, I love this because people like to compare everything to conventional bank loans. But first of all, let me dispel the truth here, okay? Of all bank business financing in this country, less than 2% are SBA conventional type loans. 98% of business financing that takes place is alternative kind of financing like I'm showing you. So even though you want to compare everything to a bank loan, keep in mind these type of bank business loans only account for 2% or less of the total money that's even being lent in the space. But let's do a comparison because a lot of people like to. SBA loans require good credit. Guidelines state 620 scores are needed, okay, but you can't have any derogatory credit. So if you look at SBA guidelines, they say you have to have 620 or higher, but they also say don't even bother applying if you have what they refer to as blemishes on your credit report. So you really have to have 700 type credit to even get approved for SBA. We've had a client denied with the 780 score for SBA because he had one Bank of America late payment 6 years ago. They don't mess around. If you have any derogatories, you're not going to get done. So you really need 700 type credit to really get done. With revenue financing, you can get approved with a 500 score and major derogs. Complete 180 from a bank loan. With SBA, you have to have collateral to offset the debt. It's a requirement. If you dig deep into SBA's S7A requirements, they actually require the lender to take quote unquote all available collateral they can get for the business. Then they further explain that if that collateral is not enough, that they then demand that the lender take your personal collateral, including your home, as collateral. This is an SBA requirement. So it's not like maybe you'll get it, maybe you won't. If you're getting a 7A, they require the lender take everything that can be taken as business collateral, and if you don't have enough, also to take your personal collateral. With revenue financing, no collateral is required whatsoever. With SBA, you have to supply 2 years of tax returns, which means you have to be in business 2 years or more. Like you can't supply 2 years tax returns if you haven't been in business 2 years. With revenue financing, you only have to be in business 6 months. With SBA loans, they take 6 to 12 weeks to close conservatively. With revenue financing, 72 hours, maybe a week, depending on how slow you are, but if you're fast, they'll get these things done in 72 hours. SBA loans look at your entire business and personal aspects. This is why most people don't get them. Think about it. How many people have you ever met in your entire life that have told you they successfully got an SBA business loan? Most people I've ever talked to have not been able to tell me they've ever known more than one person. And most people will say they don't know anybody who's ever got an SBA. They're hard to get because they look at everything. They look at your financials, your projected financials, your personal credit, your business credit, your bank credit. They look at your business bank statements, your personal bank statements, your business tax returns, your personal tax returns, how you've repaid every single loan you've ever had. They look at resumes. They look at background information. They look at all the stuff looking for any kind of fault. And if they look at that much stuff, they're more than likely going to find a fault, which is why most of those loans never close. But with revenue financing, all they look at is your cash flow. It's all they really care about. Now, they'll look at the other factors, but it's mainly cash flow that they're concerned with, not everything as a whole. SBA requires extensive documentation, including personal and business bank statements, personal and business tax returns, resumes, background checks, personal and business financials, projected financials, business plan, good personal, business, and bank credit. Bank credit is called a bank rating. If you're not familiar with the bank rating, I've got videos on my YouTube channel that will actually walk you through what the bank rating is. A lot of people don't know there's 3 credit scores out there. You have good personal credit, you are consumer credit, you have business credit, you have bank credit. Most people don't know that. You do have 3. You need to be aware. And if you look at SBA's website, they'll tell you you need to have good personal, good business, and bank credit to get approved. Balance sheets and P&Ls, articles, licenses, leases, loan history, collateral, blah, blah, blah. Revenue financing requires good bank statements and merchant statements, rental and lease information. That's it. That's it. It's like not even comparable. You don't have to go around gathering all this documentation. Give us 4 months of your business bank statements, 4 months of your merchant statements, your license or your ID, and here you go, your rental information. It's so much easier to qualify. That's why these deals are so fast, because they're not looking at all these factors. They're really only looking at your bank account statements. So this is actually an actual application for revenue financing from one of our lenders. So you can see it's very easy. Now, I really should have shown you an SBA application so you can compare the two, but it's pretty basic stuff, right? Like your business name, your doing business, your contact info, fax, email, that kind of stuff, what kind of entity you are, corporation, whatever, your tax ID, and what kind of volume you do, number of employees, and then the kind of volume that you do. Here's the rest of it too. You know, years you've owned. Again, we talked about how long you've been in business, what your annual income is, what they'll look at, what you're wanting to use the money for, some references, and any outstanding other advanced loans you have. I mean, it's a pretty simple application. Who you are, what's your contact info, what kind of entity are you, what kind of money do you generate a month, and you know, do you have any outstanding loans? That's pretty simple. So this is an actual ACH type of revenue financing application. So loan amounts are going to vary based on your current revenue. So you can usually secure as much as 10 to 12% of your annual revenue. So if you make $500,000 per year in revenue, then that means you qualify for $50,000 advance. It's really basic and simple. I just look at it as 10%. You do $1 million in business, you could get a $100,000 loan. You do $500,000 in business, you get $50,000 advance. You do $2 million in business, you could get 10% of that, which is $200,000 advance. So I just normally figure it as 10% of whatever the annual revenue is will give you a pretty good idea what you can end up with. Most loans won't exceed $500,000 for most small businesses. You must have at least $120,000 in annual revenue to qualify. 10 G's a month. That's what you need. So if you want to get revenue financing, you need to have $10,000 a month coming in consistent revenue. If you don't have that, you're just not going to get approved. The loan amounts are so small that they don't really gain anything on this. So like $120,000 in annual revenue gets you $12,000, right? It's like not a lot of money. But let me give you an example of why this makes sense. One of our clients was in the tow truck business. Her and her husband owned a beat up old tow truck that they used to like tow people for their tow business. And they came to us for money. They wanted $40,000 to buy more tow trucks. Well, this was a really hard deal to get done. Credit was bad. There was a lot of bad factors across the board. There wasn't a ton of revenue. So what happened was we submitted it to the lenders. The lenders denied it. We went to one of our primary lenders and said, we believe in this deal. We want you to believe in this deal. Help these people out. They lent them $9,000. Now, some of you, $9,000 might be a lot. You know, for a lot of others, $9,000 is hardly nothing. I mean, how do you spend $9,000? But they bought another beat up old tow truck with the 9 Gs. So 3 months later, they had paid back half because they only got a 6-month term because they were high risk. 3 months later, they had paid it back half. They got their bank statements, and these people had bought a new tow truck, had put it on the road, and had radically increased their revenues because now they had 2 trucks in business, not just one. So the bank turned around and gave them $40,000. So here they are, 3 months into this. They wanted 40, now they've got a total of 49, and the same thing continues. Less than 6 months later, they come back. The person, they have now taken the 40 Gs, bought more tow trucks, put them on the road. Now they come back, look at the bank statements again, and give the person another $48,000. So I'm telling you this because don't minimize only being able to get $8,000 or $10,000 with this. This is about proving yourself. And when you invest the money and increase the growth of your company, they will do just what I told you. These are not uncommon examples. I can give you extreme examples. I can give you examples of student loan companies that have come back and got $500,000 plus on their third advance from the $120,000 they originally got. They got 100, they increased their revenues. They came back and got 250, they increased their revenues. They came back and got 400 and change. So as long as you're reinvesting the money and growing, you can continue to get more and more and more money as you pay these things back. Now keep in mind, this person came in for 40 grand, nobody would talk to him. Every bank turned him down, everybody in the revenue financing space turned him down. We started them with 9 and they ended up with what, almost a little shy of $100,000 total within less than 12 months when all they ever asked for originally was 40, and their business is blown up. So this is how revenue financing works, and this is why I tell you don't be concerned if you only can get a smaller amount to begin with. If you use that money to grow your business and your revenues grow, you'll continue to get more advances for more money. There are no upfront charges with revenue financing. Okay, some people will charge you application fees, lenders won't, so it's not something you need to worry about. You will be charged a discount based on risk. We talked about that. The discount will vary based on the risk factors. It's like a wide range of 8 to 45%. I mean, they're all over the board with this kind of financing, but 20 to 30% rates are pretty common for your first advance. I told you earlier, they'll knock you over the head on the first advance. You're going to pay more money than you commonly would because it's a cash advance. It's just the highest risk money you're ever going to get. And these charges are tax deductible, so it doesn't really matter. I mean, as long as you can manage the cash flow, then it's tax deductible anyway. So you're writing it all off. You're getting it all back at the end of the year. The key is just to be able to manage the deduction of the amount of money from your actual bank account. Factors that affect risk include time in business, how you manage the bank account, do you have positive cash flow, the industry that you're in, your personal credit score. Remember I told you earlier, it won't get you denied, but it will tie into your overall risk and how much you'll pay. If you have past successful paid advances, all these factors tie into risk. Remember that term in months is more important to payment than rate in most cases. So once you prove yourself, you'll get offers for longer terms and lower discounts. And this is what I promised you earlier to show you how they actually look at this stuff. So here's a real example of a real client. Here was their deposits: 1, 2, 3, 4, 5, 6. 6 months deposits they looked at. They average them. This person's making about 12 grand. Here's the terms. This is pretty cool. You may never see something like this because lenders don't want you to see this stuff. Me, I show you everything. So this is how this would actually work. Based on your risk, you're either going to be traditional, gold, or diamond. Now, this doesn't apply for all lenders. Like, this is just taken from one lender. They all call their program something different. But in this case, you're either traditional, gold, or diamond based on risk. Let's say that you are a diamond. So here's what they're going to charge you. 1.16, that's 16% is your payback. 1.29 means you'd pay them back 29%. Okay, so to keep this simple, if this was a $100,000 deal and you got 1.16 pricing, you'd pay them back $116,000. If you got 1.29 pricing, then you'd pay them back $129,000. But see how the term is longer. So what happens here is with this diamond, which is low risk, they're coming in and saying, we'll give you a short term of 6 months and you'll pay less money. So if you're price conscious, here's a good option for you. You pay us back in 6 months, 1.16, your payment's $185. But if you're not conscious about the rate that you pay, we'll give you 15-month payback at a much higher rate. Now, if you look at this, it's almost double, right? The rate that you're paying is almost double of what this is, but look at your payment. It's $100 less. It's less than half as much because term is what matters. So this is what I tell you. People all the time get caught up on the pricing of these deals, but pricing doesn't really matter. What matters is term. Term is what matters most. If you get a long term, that's when your lowest payback comes. And it doesn't matter what you do. If you're low risk, medium risk, or high risk, it's the same thing. On this, the low risk or the higher risk option, your payback's $291 on 4 months. But if you went with the longer one, it's half that. It's $147. So it's the same thing. It doesn't matter. If you get a longer term, your payback is about half as much as if you took the shorter term, but you'll pay more of a fee. So it's not really, you shouldn't be as concerned about the fee because it's tax deductible. You want to get the best term you can because that's what minimizes the actual daily payback. And again, this is a real deal, so you can really see how these things play out. So you can usually use the funds for any purpose. Okay, it doesn't make sense with this kind of money just to get the money to have it sitting around, right? Because it's high cost money. But if you're going to reinvest the money into your company, then it makes perfect sense. If you're buying a new truck, if you're buying a competitor, if you're implementing a marketing strategy, other ways of using money that can result in company growth. We had a guy that had like a soda company. He designed an energy drink and he outsourced like the putting it in a can and all of that. So he wanted money to bring it in-house, and the first month he made his money back because he just needed the money to bring it in-house, and that's exactly what he did. So as long as you're using the money to grow your revenue, then it makes sense. If you're not using the money to grow your revenue, it freaking doesn't make sense. I mean, I don't usually say freaking on webinars, but I will here. It doesn't make sense. This isn't something you just get money to have it laying around at those payback terms. You need to reinvest it. So revenue financing, fast and easy to secure. Due to limited documentation, you can get your initial approval in 24 hours. You sign the term sheet, and they do a due diligence process for about a day or two. During this process, they're basically looking for issues such as like, do you have outstanding advances you didn't tell them about, signs that you might be going out of business, verification that you're renting and payments are as agreed. Okay, if due diligence is good, you can close once this period expires, 24 hours to underwrite initially, 24 to 48 hours to do due diligence, 72 hours total to get funding. It's very common. Now, a lot of our clients take a week because like they delay in getting bank statements or getting in touch with the lender, or the lender getting in touch with them. But you can get these deals wrapped up in 72 hours. If you give it a week, then that gives you room expecting some kind of delays. So also keep in mind, merchant advances are very the same. Merchant advances work exactly the same as everything I've just told you. 6 to 18 month term, 15 to 50% payback. The terms are a little bit worse. Credit and document qualifying requirements are basically the same. But with merchant advances, lenders are looking at your credit card transactions and deposits only. They don't care about your bank account deposits like checks. So they'll review your bank and merchant statements, but only your credit card transaction will be lent against, not other deposits such as checks. So that's one of the big differences beyond it's a little bit more costly. And the other reason we don't use a lot of merchant advances is in most cases they require you to switch merchant accounts. It's kind of a nuisance to me. I mean, boom, 72 hours, you're done with revenue lending. With merchant advances, you're pay higher term. They might give you a little bit more money, but they also require that you switch your bank account or merchant account, which is a little bit of a hassle. So renewals also work the same. You could typically be approved for an advance equivalent to 1 month's credit card processing volume. So that makes it where sometimes you get a little bit more money with these, but again, the rates are higher and you have to usually switch merchant accounts. So in summary, cash flow-based financing, perfect for a business owner who's looking for fast, easy money. The approval requirements are so lenient that most people can get approved as long as you have consistent cash flow. The initial terms are a little rough, but after the first 3 to 6 months, you can renew and get significantly better terms in most cases. And future renewals are very easy and fast to get, usually requiring a couple months bank statements and getting advanced in as soon as 48 hours. And you gain a huge competitive advantage because it gives you the ability to get money in your industry when most people don't even know it's available. And I give you that example. When I was in credit repair, I qualified for several of these I could have got, and it really would have given me a huge advantage if I needed the money because I could have reinvested and grown at a level that my competitors couldn't have kept up with because they didn't have access to the kind of money because they didn't know about it. So that wraps it up for today. Again, as I told you in the beginning, my goal is that you leave this with knowledge and information that you didn't have when you came into it. And if I've accomplished that goal, then I'm happy. You will get a playback of this webinar. If you actually registered, you will be sent a playback usually. My assistant Joni sends it out to you the next day. If for some reason you don't get it by tomorrow, feel free to email me. There's my direct email, ty@creditsuite.com, ty@creditsuite.com. If you have questions about getting money for your business, credit for your business, offering it as a service, feel free to give us a ring too, 877-600-2487. And again, if you are interested more in me or what we do, again, I'm not much to do pitches, but if you are interested in learning more, then just check out our website, creditsuite.com/business credit, and that'll give you all the information. If you do have any questions, send me an email. I have a webinar starting at 3 o'clock in 4 minutes, so I can't hang all around for questions, but if you do have questions, send me an email. I always make sure your questions are answered. I will never let you have outstanding questions that are not answered, so if you do have questions, feel free to give us a call or send us an email. I'd like to thank everybody very much for taking the time to attend this webinar. I know you're busy. I do not want to waste your time, so hopefully you got a lot out of this. I appreciate you carving out an hour out of your day to join me. So thanks everybody very much. Hope you have a great day.